We are extremely pleased to welcome you to today's call. As you can see from our first picture, we have a new picture that we're going to use for our new homepage in due course. It's basically a picture that shows Lachen from the lake, and you can clearly see why our street name is called Alpenblickstraße. With that, I would not like to waste a lot of time because we have several topics to discuss, and I would like to pass on to Marcos. Marcos, please.
Thanks, Alex. Good morning, everybody. Thanks for joining the call today, beginning of July and close to the holidays. So you can see here the themes for today or the schedule. Basically, it's going to take like 5 minutes per every part, and the whole call will last 45 minutes, and then we will open for Q&A. So I'm going to start with the base case economic scenario, the economic scenario that we have. You know that we are not macro guys, and our investments are not following the macro, but it's important to us to have a base case scenario. We started January, beginning of this year, with a recovery outlook for 2025, but we have two things that have made an impact. One is the tariff or the trade war implemented by Trump around April. The second is the worsening in the Gaza and the war in Gaza, and also the mini war between Israel and Iran. So we are taking down our estimates for 2025 in terms of global GDP. Basically, in the US, between 0.5 and 1 point lower GDP growth, and same for China. This is consensus. But the main message here is that the cyclical improvement we were expecting for the second half of the year is going to be delayed. You can see in slide 4 the impact of the tariffs. So this probably has been the most, the event that has mostly affected the macro this year. So you see that last year, the tariff, the US tariffs on imports were around 2%. And now this jumped in April, in Liberation Day, around 26% on average after 145% tariffs on China. And now you see that there are negotiations, and these tariffs are being negotiated and reduced. So at peak moment, they were 26%. The last number we got is 13%, the total impact. And in our view, this will be lower. And probably the end figure this year will be 10% and going down. So, you know, message here is we shouldn't be too worried about this causing a recession. The industrial cycle, you know that we follow it very, very closely in order to understand a little bit the macro bottom up. And again, we were wrong. We were expecting a recovery by mid-year, and this recovery obviously goes with GDP is going to be delayed, probably for 2026. You see that all the big economies, US, China, Europe, are below 50, which means kind of a slowdown in industrial production. But we have good feeling in residential construction. We have good numbers. In the US, for instance, 1.2 million housing starts is very, very close to the cyclical low. The historical range from memory in the US in terms of housing starts is from 1 to 2 million. So when the market is depressed, you go to near 1 million housing starts. We are there, which means that near the lows. Also, you know that we are very, very optimistic on the fixed asset investment cycle, CapEx cycle. So we will see investments in technology, in data centers, in infrastructures, in energy, in electricity, transition, supply chains, and even in defense. So it looks like, you know, the IP should rebound, maybe not in June as we were expecting, but probably by the end of the year. Inflation, just some seconds here, because inflation has normalized. On the left, you see the US. On the right, you see Europe. Basically, we are close to the target, more in Europe, obviously. And with the slowdown, with the economic slowdown, you know, this is helping the inflation. So we shouldn't be worried about inflation this year, probably next year. But longer term, we see upward pressures in many, many fronts: energy, labor. There's several, you know, key factors that are signaling inflation, kind of midterm. And China. We try to follow China, what is going there, and you can see I chose this chart, which is quite amazing. You see that in the past kind of downturns, the Chinese economy rebounded relatively fast. So in 1999, a couple of years, in 2009, half a year, which is surprising. In the 15, a couple of quarters. In 2020, only one quarter. So, and now we've been there like almost 4 years. The numbers, you see them, it's, investments are growing 3% per year, industrial production is growing 5% per year, consumption around 5%. So it's not really that the economy is super weak. The reality is that the property sector is really in a big or deep downturn. Still, it's more or less 20% plus of GDP, so very important for China. And completions are around 20%, investments are around 10%. Still, the last data we have. So the downturn is taking already 2-3 years. And, I think, or we think that basically the Chinese government needs to tackle some structural measures. They need to do something else in order to help the property market to be back. So they are doing things, but not enough. At some point, this will turn. Conclusion from the macro perspective, very fast, is that sadly we are delaying the recovery. So probably we'll have negative data for the next couple of quarters, kind of negative delta. But we do not see a recession. So this is consensus, because otherwise the markets would be much lower. So we are not far from consensus, which probably expects the same slowdown next 2 quarters and then recovery in 2026. And then, as Buffett says, let's quote him, let's take advantage of this and be greedy, right? Is what we are doing. So I'm going to talk a little bit about how expensive is the market. We like to review the valuation of the market twice a year, because, the media is every day saying how expensive it is. I'm going to start with value. If you look at value, this is the MSCI Value Index and the MSCI Growth Index with their components. You see that PE of value global is 15 times below the historical, which means that at least from a value perspective, and we are value investors, the market is not cheap. We can discuss growth later, which is a bit more expensive. And related to value, I wanted to highlight this, that we have been kind of repeating in the last meetings because we think it's important. We think that the fourth value cycle since the World War II is here. So you can more or less identify 3 value cycles and 3 growth cycles. And we are convinced that we finished the last growth cycle that has taken 15 years, from more or less 2010 to 2025, around that, because it's very difficult to select the peak. You can go to 2008, you can go to 2010, but basically 15 years of downturn. We think now we are on a value cycle, basically on valuation. Well, we say value is trading at 15, growth at 28. Then we see the maturity of the Max 7, which are a heavyweight in most indices. And finally, there's a huge correlation in the economic cycle with value. Value is very correlated to inflation, to investments, to commodities, to employment. And we think we are in this phase now. We will see higher inflation. We're not talking about 10%, but we are talking about 3-4% and upside pressure. In terms of the rest of the indices and the markets, you can see in the slide 12, I like to take a look to this SPW on the upper table. On the left-hand side, you can see this is the equal weighted Standard & Poor's 500. It is trading at 17.5 times, 17.4, which is below historical, around historical, same with price to book, which means that the market, excluding the big 7 impact on the indices and the huge weightings, is not expensive against what the media is every day banging in the press. And you have more or less the same reading in Europe, in China, in Brazil. The rest of the countries, I don't see a bubble anywhere. Just the Nasdaq is a bit expensive for obvious reasons. And then if you go to the table down, you can see by sectors that the only sector that trades on demanding multiples is technology, 30 times earnings, 8 times book. The rest of the sectors are not expensive. They're around historicals. Maybe industrials is a bit expensive, probably because they are feeling the capex cycle. But technology, I remember that in the bubble, in the year 2000, technology was trading at 10 times book. So we need to be very, very careful with technology at 8 times book value. It's already very demanding. Conclusion on the markets, on our opinion, Mr. Market is not expensive against what the media is saying every day. Only technology, maybe the Max 7 and the Nasdaq are a bit expensive. The main difference, and this is why the press is not really getting it right, the main difference or the uniqueness this time is the corporate margins, because across sectors, you see that corporate margins are all-time high and returns, obviously. So earnings are too high. Is this sustainable? Will these margins normalize? So if we were to converge all the sectors to the historical average, obviously the market would be expensive, but this is not going to happen. All the sectorial margin return performance is a long-term issue, more depending on competition and regulation and taxes than other things. So this doesn't change from one day to the other. The second big difference this time is obvious, is the Magnificent Seven. I mean, just one number that I was surprised. These guys are able to invest $200 billion per year in R&D, more than Germany. So 50% more than Germany. It's amazing how, the balance between corporates and countries at these levels is being somewhat distorted. So we see how this goes, but in the end, the Max 7, they account for 1/3 of the American index, huge weight on the indices. And in our view, this is getting mature. So it's going to be very difficult that these guys grow at double digit, which is what they need in order to sustain the valuations. So that's it for the macro and for the valuation. I'm going to hand over to Alex on his comments on expected returns.
Hey, thanks a lot, Marcus. Maybe next slide. I mean, what we did yesterday was actually updating our seafood profitability chart here for the LTIF Classic. That's basically something that we have started many, many years back. And the idea is to look at the fund as if it would be a holding company of 35 lines. And then we sum up everything. And what you then get is basically down there on the left, the earnings per share of the fund, as if it would be a holding company, then the dividend per share, and then the book value per share. And then, of course, you can conclude that the PE of the fund, for instance, based on 2026, is trading at 13.5 times relative to the index, which is at 21.2 times. 7 times, sorry. And we have a dividend yield close to 3% relative to 1.8%, and the price to book value, which is almost half of the index, which is at 1.9. Now, these figures are based on Bloomberg mean estimate. So basically, we take the average estimate of the Bloomberg analyst, add it up to our companies and weight it accordingly, and count all the earnings power together and compare it with the assets that we have in our fund. Now, that's one side to look at it. And the other one we're going to show in the next slide, which is the expected return. Because the expected return is based now on our own calculation. So per company, we do an IRR expected return calculation, which is basically borrowed from the private equity world. And to make it very simplistic to explain how it's done, let's assume we would buy an apartment building and we will pay 100 of it for it. And then this apartment building would have 5 blocks and we would get rents minus depreciation per year of 5. In that case, the expected return of this real estate investment would be 5%. Now, we look here at the chart, which is the red line, which goes back to 2019, basically looking at the situation where we basically had as a massive jump when basically, just allow me to still some people coming in. Basically, we had a massive jump then in COVID, going to 20% expected return. And the blue bars represent the NAV of the fund. So basically, we were joking, either we were totally drunk in March 2000, that the expected return was showing 20%, or the NAV has to jump up dramatically. And you can also see that the expected return normally is within a band of 13 to 16%. That's a band of plus minus 1 standard deviation, and rarely jumps out of this band. Now, with this trade war that we have seen in April, that Marcos was talking about, our expected return jumped to 18.8, almost 19%. Now, the current figure basically shows a 16.8%, which is still very, very attractive. Now, we have to deduct some fee from that. We have to deduct some mistakes that we do. But basically, in bottom line, we clearly expect to make 10 to 12 to 13% out of that. Next slide, please, Marcus. And basically, that's then the next step. 4 years ago, we started to give a guidance. Where do we expect that the fund price should be at the end of the year under normal circumstances? Now, this guidance has been calculated by Marcos. So 3 times in a year, in a row, he was almost extremely precise. So we had to pay him a lot of beers for that. But now the situation is, don't expect us that NAV at the end of the year is exactly here where you see the red bar being in 2025. It can be half of it. But you know, what is important is that the anchor is much, much higher. And that is basically the main message, that I think by now we have got a lot of grip to our portfolio. That's why we are able to calculate our expected return. And I think that gives us a lot of confidence. And we do that on a single stock basis. And whenever a stock is hammered for a wrong reason, the expected return of that stock jumps up like the fund did in COVID, and we increase that one, and vice versa for other companies that have gone up too much, like Thales this year, because everybody runs into defense now, and we are forced to sell because this horse was running too fast. Now, just very brief on the next slide, just the same calculation. For the net resources fund, 12.3 times earnings 2026, almost 4% next in 27, almost 5% dividend yield, and the price to book of 1.3. And here you see that we are not far away from the net resources S&P index, the net resources equity index, but still offering almost 1% more dividend yield on the basis of 2027. And that was it from my side. And with that, I pass back to Marcos.
Thank you, Alex. So let's go to the classic a little bit in detail, the long-term investment fund classic. So what are we doing this year? Basically, we entered 2025 with a conservative approach. 2/3 of the fund was low risk categories. You remember that we classify all our stocks by categories. 1 and 2 is very low risk, 3 and 4 more cyclicals. So we were conservative on the construction of the portfolio and 8 to 9% cash. This was in the beginning of the year. And then we were lucky because we got a bid for Catalana de Occidente, an insurance group we bought a couple of years ago. And these added 3 points of cash. So then the liberation then came, and as Alex said, the IRR jumped to 18%, and then we decided to start reinvesting. So the question was, we need to reinvest, but what is the pace? Because everybody was fearing a recession then, or 60% chances or 17% chances of recession. So we decided to invest half of it in April, but we didn't change the portfolio mix. So waiting for another 15% correction, which didn't happen, right? So we were able to invest half of the cash at very, very interesting yields, which means that the IRR now is close to 17%, as Alex said. In the fund now, we have 1/3 in 3 sectors that have done really, really poorly: energy, mining, and salmon. So 1/3, let's put it this way, it's very cheap, confirming this high IRR, and there's other stocks that are relatively cheap also that sustain the hidden valuation of the fund. And what has gone good this year or positive has been aerospace and defense, where we are selling a little bit, cleaning services with ISS, doing very well, financials, banks, and then the takeover bid on Catalana Occidente. By stocks, Metsol, MTU, Raytheon, Greek Seafood, and Catalana have been the winners. We've changed a little bit, you see in slide 21, how we disclose the main positions. So we are going to stop giving too much detail on the weightings because we think it's more important to explain how well diversified we are and how good the quality of the business is, rather than discussing if it is a 5 or a 6% percentage of the fund. So you see here that more or less this is 45% of the fund, and we have everything. We have digital vouchers, we have cleaning, we have salmon, we have pharma, we have semiconductors, medtech, plasma proteins, electric cables. So all of them are global. So the important message here is that the fund has quality and value both, and that it's ready for a recession. Nothing should kill us. So this is maybe, sorry to repeat it again, this is the same chart that Alex showed on a bar type of chart. Here is more aligned. My message is very easy here. We will not be as close as the target every year, as Alex said, but the path should be this one. The other thing that I want to say is a bit different is that, you know, checking or backtesting this 10% per year net, going back to 2012 when I started to run the fund with Carlos, then you know that from 2019 I'm the portfolio manager. So you see that long term we're making this 10% per year already for almost 15 years. And then if you see the two circles is where the markets are going down in COVID and in Liberation Day, and is where when we buy. We are buying, and then when we buy, we enhance the returns. So this is something that is my espoir, like the French people say. So on the blue line, you see the 10% performance, our official objective. And in the red line, you see what the fund has to do if our IRR currently is correct, which would be 15% plus net of fees and expenses. So hopefully, as Alex was saying, we should be in the middle of the two lines in the next few years. And why? Well, because if we buy on the downturns, we enhance the returns. So we've been doing so in the past 2 years, 2020, and now with Liberation Day. Also in 2022, we did a little bit, which means that we try to enhance the returns. So we'll see if this happens. But it's interesting. And again, on the same, a bit boring, but let me just highlight two things. First of all, since 2019, this fund has been trading on normal markets between 13% and 16% IRR with an average of 14% more or less. This is gross. You take out 1.5 of fees and costs and you go to 12 point something. So 12 point something percent per year is what we have done since 2019. So you can see that the 12.5 is very reliable. But then taking the example of the COVID here, you see that in 2020, March, I think was the low, we took the IRR almost to 20%. And look at what has happened after the COVID. So I took the 20th of March as minimum, and you see the classic, the performance has been 22. So we are gaining confidence that the IRR that we see in our numbers is kind of representative and meaningful. And yeah, the COVID test. Okay, sorry for that. Let's move to the next chapter, which is Leroy. I apologize to mention maybe too many times Leroy, but it's important to us because it's a big position. We have a big position in salmon, not only Leroy, but in 4 names. And I wanted to just explain a little more what is going on. So what are the negatives? The negatives are basically 3. Tax hikes and some regulation changes in Norway that happened in 22 and 23. Cost increases. So there's basically because the feed of the fish, which is fish meal and fish oil, basically is having a lot of inflation, more or less 10% per year for the last decade. And then this year we're having perfect biological conditions. So the temperature of the sea, the currents, the virus, everything is working very well. So the biomass in the sea is very high. This year it's up 10%, 11%, pushing prices down. So we have a kind of combination of negatives, and this is why the sector is down a lot in the past 2 years, and we are buying like crazy. So what is our view on these negatives? On biological conditions, we think this is cyclical. So 1 year you have a good year, the next year you have a bad year, and on average, normally years are hotter and worse. So no change in our supply views, which in our opinion, supply can grow 3 or 4% per year max. The rising cost, in our view, it's not a problem because it's rising for the whole sector. So it's taking the cost curve up for the whole sector, which means that sooner rather than later, this will be passed through the consumer, so the buyer. And then the tax changes in Norway in 2023, which affected only Norway, they're already in our numbers, so already in our IRRs and IVs, and this is already reflected. Also, we think that Faroe rose taxes also, and probably Chile will follow the Norwegian model. So in the end, again, we will have the whole curve rising, which means that these taxes will be also paid by consumers. Also taking into account that competing proteins are also seeing a lot of inflation. So it's not that chicken is cheaper. The whole protein world is having a lot of inflation. So, we think there's not a fundamental issue. Maybe the most uncertain factor is that the Norwegian government wants to review the regulation in the next 2 years, and they have announced it. But the target is to improve living conditions, and taking biology to the highest standards, which for us is fantastic. So we don't think that this is going to affect the profitability of the sector, and even they could limit the growth. So in our view, the sector remains super interesting, and we have bought a lot. Leroy valuation, just to give you a hint on the valuation, if you go a couple of years ahead, 2027, below 9 times earnings, close to 1 times book value, and return on equity should be more than 15%. So, we think we are investing at a 17, 18% return, and we should be almost doubling Leroy Seafood in the next 4 or 5 years. Okay, that's for Leroy as investment case. On the natural resources, this year is being very challenging, but this is normal. I mean, you know very well, this is a high beta sector, and we are in a slowdown, as we said in the beginning. So it's quite normal for commodities to underperform. Demand is weakish, and then you see some downgrades. Commodities prices go down. So last year already was tough, although we did well. We did an 8% in 2024. And 2025 will be challenging. Now I think we are down 3% year to date, so it's not bad, but we'll see what happens in the second half. Most of our investors are well educated, and we repeat it really a lot of times that we invest for the next 5, 6 years. So for us, this year is a great opportunity to stay buying. And the last trades we made, we are buying more oil companies because they are super, super cheap. And the moment where Mr. Market will anticipate the recovery, we think by the year end, then this can help the sector a lot. So the cycle, as you know, in our view, is going to be very, very long. We're talking about a decade. So it's fantastic to have the opportunity to buy on the cheap. Updated IRR on the natural resources fund, 16%.
Okay.
Converge intrinsic value, 250 euros per share. The last price was 155, 160, more or less. So still very interesting IRR. Just tell you that our IRRs and our IVs are mid-cycle. So we are not really trying to value the upper part of the cycle. So if we are right and the cycle is going to be on his upper leg for a decade, then the numbers will be much, much better. But so far, it's good to have these mid-cycle numbers with a 16% return expected and 250 euros that we should see in 2-3 years' time. And we keep buying, of course, you know us.
Maybe, Marcos, just a small point from my side, for the audience. The NAV is down in euros 3%. Most natural resources funds are traded in dollar, and in dollars we are up 9%. Just this little side note.
Yeah, no, that's right. I mean, there's a huge impact of the dollar in most of the comparisons this year, so it's very fair. On the composition, so we do the same for the natural resources. You see the first 10 holdings. First Quantum Copper, Leroy, Salmon, TGS, a seismic technology company to find oil for EMPs and to do these seismic shootings. Tech, Copper and Zinc, Nexans, Electric Cables, EOG, US Shale, Harbor Energy, North Sea Oil. We have uranium. Basically, you know, I think the message here is that we have focused on the three commodities that we see structural undersupply. One is salmon that I try to explain, where demand is growing 8-9%, supply 3-4%. We see a very interesting sector for the next few years. Copper, I think this is consensus. There are not enough mines in the next 5 to 6 years to cope with demand. And in oil that I'm going to enter in detail. So this is, you know, you see that the rest is very diversified. We have some gas, oil services, uranium, etc. But the key things for us are oil, copper, and salmon. I will develop oil a bit in detail now. So on oil, there's a lot of things going on, but I'm going to summarize. Here you can see the spare capacity. So the spare capacity on our numbers is not this 4.4, it's around 5 million barrels a day. 4.5% of the world oil supply is now controlled by OPEC, or spare capacity by OPEC plus. Why? Because they have been 4 years since the COVID trying to manage the market. So when the prices go up, they open the tap, prices go down, they shut down some fields. And they try to keep the prices in a range with is between $70 and $90 Brent, so average 80. And this has been valid for the last 4 or 5 years. And we think this will continue. So there is enough supply because there is this spare capacity in order to have a balanced market for the next 2-3 years, and OPEC Plus will probably continue to intervene. But this is the elephant in the room. This is US shale, and US shale is maturing. You know very well that depletion here is very high. Depletion is 30% plus and increasing. And you know that at $70 WTI, and the WTI is now well below, the rig count and the frac operations start to go down. And this is Permian. You can see in the chart that even the Permian, which is the best shale play, the frac operations are going down. So this is a matter of time where production will go down. In summary, what do we expect for the next 5 years is demand growing between 1 and 1.5 million barrels a day, depending a little bit on the macro and demand, to 2030, and supply at these prices growing by 500,000 barrels a day, which means that the spare capacity will be used in 2-3 years' time. Don't forget that we need more or less 3 million barrels as a spare capacity in order to offset events. So there's a minimum in terms of spare capacity that we think is 3. So really the effective spare for us is 2 to 3 million maximum. And this will be used in our numbers in the next 2-3 years. Whenever we reach this level of inventories or spare, oil prices need to move up a lot. Remember that the oil demand is very inelastic, so prices will move up a lot in order to incentivize new supply. And in the next slide, I mean 38, you can see more or less the summary of everything. So production in 24, 103 million barrels a day. Then you can more or less equal demand, cumulated demand for the next 5-6 years, cumulated supply for the next 6 years. So these 4 million of new projects, you can offset them with demand. So take this off. The important thing is the declines. We have 17 million of declines for the next 5-6 years. So the supply gap is going to be big. And you know, why we didn't have a problem 10 years ago or 15 years ago is because we found shale oil. I mean, shale oil has kind of filled the supply gap that people were expecting 10 years ago. So we need to, in conclusion, we need to find a new shale. And you know, what we read, what we learn, there's no reserve enough new shale oil that is going to take another 10 million barrels in 13 years. So this is what, keep us thinking that this is going to happen. So conclusion, well, this is something that people ask us a lot. Why are you investing in oil when you think that the market is well supplied? The market is well supplied. So, everybody's negative. Why don't you wait? And, the response is clear. Shares are super cheap. If you look at our investments, our IRRs are 16% or more using 80 Brent and 3.5 MMCF for gas as incentive prices, which is not really challenging. Free cash flow yields are double digit, which is very interesting because the sector is doing a regime change from investing on any return to investing at a double digit return. So really in the US, you see that they are more and more disciplined. And if this happens, basically what they do with the free cash flow is buy back shares and pay dividends. And only with this, we are getting a 10, 12% return at the current prices. And then, as I said, we're investing here for the long term, for the next 5, 6 years at least. And if we are correct in our scenario, in the next 5 years, we'll see oil prices well above 100, well above 100. So we're talking about, I don't know, 130, 140 above incentive in order to push for new fields. So the IRR will be even better than the 16%. And finally, it's something that is very difficult to see is there's a lot of options in the market that are very difficult to anticipate because, the bull cycle can come at any time. You have a structural lack of investment since 2013. You have very difficult geopolitical balance. You have the Middle East problems. You have problems in Venezuela, in Russia, and Iran. So a lot of producers are countries in kind of difficulties. Then there is a decline problem in shale oil that has to be seen. We need to see what is the impact when investments go down, and we will see that in the next few years because geology is getting more difficult. It's not us saying it, is the CEO of Occidental, is some other CEOs in the US are saying that the geology in the US shale is getting more complicated. After 15 years is normal. And then we have ESG, CO2, taxes, the usual problems for the sector. So all this is pushing for the upper part of the cycle to come earlier. So we want to be there and take it from the low. So that's for the oil update. I'm going to pass it to Urs and some comments on the natural resources.
Thanks, Marcos. I have here a chart. That's the copper chart. Unfortunately, the little hand notice I made disappeared, but there's a saying in technical analysis, divided the base, the higher in space. So copper is actually breaking out now of a 20 years consolidation. The price is actually $5.10 per pound. And whenever you see such technical setups, you better check out the fundamental situation if it's aligned with what the chart shows. Maybe the next slide, Marcos. So I've already pointed to this since I think autumn last year, that we have these structural problems of declining treatment charges, which is the cut the smelting industry gets from refined copper. Most of these treatment charges are fixed on an annual basis, but some are fixed on a semi-annual basis. And this is virtually a breaking industry now. This trade has been broken. So treatment charges are fixed at zero, and the Fagasta then did some with China, etc. And this is an unprecedented supply shortage of concentrate, which is really breaking this industry now. So this industry is broken, and we will see a huge restructuring of the whole processing and smelting industry. We had quite some expansion of capacity in recent years, particularly in China, Asia, where obviously the most metal is getting treated because the demand's there. And everybody foresee, the rising demand for refined metal. and therefore we had a lot of capacity investments. It's not just in copper, it's in nickel in Indonesia and so on. But unfortunately, nobody invested at the very front of the chain, which is the mining industry. And this will obviously now translate into massive decline of output of refined metal. And this is pretty dramatic. So I would maybe think again, if you have too much of refining companies in your portfolio. I think the market is still not recognizing what's happening. And obviously same in the mining industry, the market is not recognizing how drastic this concentration shortage already is. And of course, we had 4 years of a recession, general depletion of inventories, negative market sentiments, but we will now be faced with a drastic reduction of output of refined metal. I've listed here, or the newspaper listed here, a few of the reasons. And whenever you see such a situation and you see such a chart, usually you get quite a drastic spike in prices, which in my opinion started. Maybe the next slide, Marcos. This is the same for zinc. You have to know that refiners, they do fix a price or a contract, an offtake agreement with miners for concentrate. Usually or always you have a concentrate has various mineralization. The question is, what is the grade? You might get paid as a miner for some of the metals contained or not. But this is not something which is solely concentrated on copper. Copper is the biggest market. Zinc is the second biggest where you have such treatment charges officially, but this will affect most or all the metals because they all occur in the same concentrates. The biggest copper mine are often some of the biggest zinc mines. You have a lot of byproducts in it, molybdenum, cobalt, silver, and so on and so on. Therefore, you see the same situation, for example, in the zinc market. But you will see it also in the nickel market soon, depending a bit how large the inventories still are. So metals had a bit a spike in inventories due to the whole hype in battery, etc. But this will affect most metals, so you can expect quite a sharp price increase. Usually you have in the commodity market a leading indicator, which are more the precious metals, which are reacting to the anticipation of policies of central banks. Later comes industrial metals, and energy is usually lagging. That was the case in 2003 or 2004, but also on the peak. I don't have really an explanation why this is the case, but it seems to repeat again now. Maybe the next slide, Alex. Alex and myself were recently on a business trip in Milano and Torino. And sometimes, you have to take a bit things in simple perspective. I just told the people that, with half of the market cap of NVIDIA, you can buy up the GDP of Italy. So you get twice the GDP of Italy for market cap of one industrial company, which might have a good business model, but in this business, things are evolving so fast that maybe in 5 years your product is already obsolete because you have a competitor who does it cheaper in China, wherever, or maybe not. Or NVIDIA could make a 1 to 3rd share issue, meaning for every 3 shares issuing 1, and then you can buy up the complete market capitalization of Italy. So obviously then I would ask myself, what do you want to own for the next 20 years for your children? The whole country of Italy virtually, or half of one company in the US? So everybody can think for themselves, but I have to admit that in regards of Italy, due to personal reasons, I might be a bit biased. But obviously coming back to the mining industry, so, we are not people who do understand anything about technology and hardly can open a laptop. But, this financial bubble with cheap money is also visible in our industry. I have 2 charts here on the left, and I advise everybody when you see such charts, like 5 years ago and breaking out on the upside, you should rather be not too arrogant or ignorant to look at it, because usually what means after such long bases and low prices, the supply is decreasing because prices have been too low. Obviously, the market is very negative, and I remember 5 years ago, you heard this completely ridiculous narratives of nuclear industry not being used anymore. This is completely ridiculous. Now you hear the same bullshit about coal, which is as ridiculous. But just put things in perspective. These two companies have virtually the same market cap, around 30 billion at the moment. The company on the left has two mines, which are actually, in terms of the size, employees, they are quite small. They're working 300 below 300 people per shift, and they have a minority joint venture in Kazakhstan, and they recently bought 49% minority of Westinghouse. The company on the right virtually owns the world. It has 60 assets in 30 countries and is active in 60 commodities. The company on the left has 3,000 employees, and Westinghouse has 9,000, so you can add another 4,500. So let's say we come up nearly to 10,000 employees. The company on the right has 150,000 employees, so it's more than 15 times bigger. Coming to financial figures, revenues, the company on the left has 3 billion revenues, maybe another 2.5 Westinghouse, so let's say 5. The company on the right has 230 billion revenues. And if you take like the profit margins or EBITDA, the company on the left has, a bit laughably 270 million EBITDA, maybe 100 million plus from Westinghouse. The company on the right has 14.5 billion EBITDA, and you get it for the same price, because market has narratives. So just to solve the riddle, the company on the left is Cameco, which we once owned but sold due to valuation, and the company on the right is Glencore. So you get virtually 15 times bigger company for the same price at the moment. And then what Marcus talked about, just one slide, this is the drilling rig, the oil drilling rig in the US. So that has nothing to do with the president, whoever it might be. It's just clear that the drilling, the amount of drill rigs is collapsing now due to the prices, which are far too low. So oil companies calculate with a margin of safety, like everybody, to sustain production on the long run. I would guess we would need $100, because marginal production costs, whatever this might be around 80 with a margin of safety. So you need higher prices, and these trade wars, it's a bit a funny thing, if you would really have a sound oil industry in your country, you need prices which are good, not too high, but good. But the problem is they are obviously far too low, and the production will be declining, and this is nothing that can be stopped in some ways. So I think, Alex, that's your turn now.
Thanks a lot. I mean, that's basically to sum up. I mean, as you know, we really are looking for long-term partners. I mean, we call our fund long-term investment fund, but we really like to have actually partners that share our long-term view with us and work with us. So our investment philosophy is clear: strategic value. We are non-institutionals. We manage our own money, as everybody of you know. We think we are pretty experienced. Quality value is important for us. It's not just value, deep value. The track record we discussed, and the long-term view, and at the end of the day, transparency and honesty. And just to give you a little example, we were quite pleased, whatever it's worth, to get this information that in the German magazine Das Investment, a couple of weeks ago, we were on #1 out of 1,476 different global equity funds, with our fund in actually euros, and the second one was even the distribution share class. So we are pleased that finally we are actually seeing some indications that people are looking at us. When you look at the Bloomberg, you see similar things. Both funds that just checked are again on top decile over 5 years, which is basically the area we are looking at it for us ourselves, because on a yearly basis, it's very difficult to be always on the top. That will hardly be the case. But our plan is really to be among the top 10, basically over 5 to 10 years. And next slide, please, Marcus. That's the structure that you know well, and that's basically then the ending slide. Yes, and then I did something with AI to conclude, because everybody talks about AI, so I thought I'd test it out myself and ask ChatGPT to make the four of us more experienced. So asking ChatGPT how we look like in 25 years, and believe it or not, the computer was actually taking the same time. I'm not sure if we are able to keep it for that long. And in addition, I was also asking the computer to put on a jacket so that we really look senior. That was basically more or less it. Now I already see that we have received some questions, which is fantastic, because I just wanted to ask some questions. So somebody is asking us our expectation on lithium, maybe yours, in the coming years.
Yeah, obviously that was a typical investment bubble. I think the lithium price has probably found its bottom, but you know, there has been so much investment in production capacity, which, in my opinion, taking the biggest company, Albemarle, you know, there's a lot of the lithium is most of it, half of it comes from Australia, hard rock lithium, and is processed in China. And due to this problematic about you know, depending on China, etc., there was a massive investment boom in mining and processing lithium, Latin America, and then processing in the US. Obviously, this is a very good idea, but unfortunately, it's not working anymore because the lithium price is too low for that to be economic. And usually, you know, I think that the problem, what's going to happen is the price might not going down more because production is declining. But unfortunately, if you are a company and have, you know, a market cap that by 2/3 is representative of a production that cannot be economic, your company might still go bust or at least lose a huge part of the market share. So I think, according to my experience, such investment bubbles and overcapacity tend to take a few years to clear. And I think it will be somewhere when nobody talks about it anymore, and the companies are sound again with a restructured balance sheet. The debt has been restructured, and you might buy them on the 9 times earnings. And in 2-3 years, it could be an option, but in my opinion, it's far too early. Not the lithium price, but the companies, because they will have problems with this price, you know, because it's too low for a big part of the production that has been built.
Thanks a lot, Urs. We have actually received more questions. One of them was actually asking, where do we stand with our launch of our institutional share class? There, I can tell you that CSSF is currently reviewing that. For everybody, the information, we have decided to come up with institutional share classes for investors that are above 5 million, and there will be a 1% management fee. And in the case of the classic, there will be no performance fee, also because of the fact that the performance fee that we still have in the classic in normal share classes is quite far away because of the hurdle rate of MSCI World, and we know what MSCI World did the last couple of years. Maybe a last question for Urs. Do we plan to invest in silver mines?
No, not really. It's a bit difficult because it's not really something which is available, because silver mines actually don't really exist, in my opinion, because silver is never mined as a primary metal. It's always a byproduct, mainly from something that is called galena in mining terms, which is a combination of zinc, lead, or in a combination which is called electrum, which is a combination of copper, gold. So silver is mostly a byproduct of copper, gold, or zinc, lead. which means that most of it is mined from the big zinc miners like Glencore, as an example, or from the big copper gold miners. Of course, in these companies, the revenue is so small that it's not really representative. But if you look at the performance of the so-called pure silver companies, they are disastrous, and that's in my opinion because they're mostly unproductive zinc lead mines or unproductive copper gold mines. And in my opinion, it would be better to buy the physical ETF. That doesn't mean that when you get a big spike in price, of course, such companies go up because of the narrative, but really from an industrial term, in mining it, making money out of it in industrial terms, it's difficult with these so-called silver mines.
Hey, thanks a lot, Urs. There's another question that we take because it was stated. What is our opinion on yellow cake? Maybe Marcos?
Yeah, we've been invested in the sector for the last almost forever from the downturn. So we've been invested in Cameco for many years, and we've been selling because the price is too demanding. Then we invested in Kazatomprom, as you know. So in order to have more exposure, even taking into account the risk. So these two are still in the natural resources, Cameco with a lower weight and Kazatomprom with a normal weight. And then we were thinking about yellow cake. So because uranium prices corrected, and we were discussing that in the investment committee. So the question is very accurate. Maybe it's a good option because you don't find other industrial companies where to invest. You only have really Cameco and Kazatomprom. And you know, yellow cake and maybe Sprott are kind of valid possibilities to increase exposure on uranium. We are super optimistic on uranium. We think that longer term demand is going to explode upwards and supply is going to be constrained. So yes, I mean, the question is very valid. Maybe yellow cake will jump in.
Absolutely. Thanks a lot. I think with that, we conclude because we almost now hitting the hour. Thanks a lot for everybody who was there. I mean, we had in the peak 45 people visiting us, which is fantastic for this great summertime. We wish you all to have a great summer. We will have our Natural Resources Day on the 11th of September in Zurich. And let's see if we age that well and we can talk to you in 25 years like shown in this picture. Thanks a lot and take care. Bye-bye from Lachen.